In 2024, there was this algorithmic trading desk, and they ran a natural language processing model that parsed, I think it was like 3 million tweets.
Oh, wow. 3 million.
Yeah, 3 million. And they were specifically hunting for the word nervous
Mm,
alongside a handful of, really obscure financial tickers.
right. Just that one word.
Just that single emotional data point. And by tracking that, the model successfully predicted a multi-billion-dollar market sell-off a full 48 hours before it ever showed up on a traditional chart.
Which is just wild to even wrap your head around
It's
here.
completely crazy. And welcome to the deep dive, because today we are taking a massive stack of excerpts from Nathan Bensby's book, Sentiment Analysis, and we are completely dismantling the idea that the stock market is some rigid objective calculator.
That's definitely not that.
Not at all. We are looking at the market not as a machine where, numbers go in, predictable profits just pop out, but as a living, breathing, and highly volatile ecosystem driven entirely by human emotion.
And, I mean, it is a radical reframing of how capital actually moves. Because the conventional wisdom for decades has been heavily anchored in pure technical analysis.
Like the old school chart reading.
Exactly. The belief that if you just stare at price charts long enough, the geometry of the lines will just magically reveal the future.
Just draw enough triangles and you will be rich.
Yeah, exactly.
Yeah.
But Bensby's core premise just shatters that completely. He argues that relying on historical price data without understanding the underlying emotional current is essentially driving a car by only looking in the rearview mirror.
That's a great analogy.
I mean, every single mark on a chart is just the visible artifact of a much deeper, invisible battle between human fear and human greed.
Well, and the author even admits in the text to falling victim to the illusion of pure technical analysis early in his career, Like, he treated moving averages and Fibonacci retracements like they were fundamental laws of physics.
Right, like gravity.
Yeah. Only to realize the hard way that a beautiful chart pattern means absolutely nothing if the crowd suddenly decides they just hate the asset.
They'll dump it regardless of what the chart says.
Exactly. So for anyone listening who has spent years fine-tuning their technical indicators, or anyone who just hates financial jargon because it feels like cold math, Bensby's framework is going to be a huge relief, but also challenge a lot of assumptions.
It really treats the market like a beating heart rather than a calculator.
Right. So the goal today is to synthesize a truly holistic toolkit for you. We're going to decode the visual data on the charts, anchor it to the fundamental economic realities, and then crucially learn how to read the emotional pulse of the crowd that actually dictates the price.
And to do that, we really have to start at the absolute micro level of the market's visual footprint. Because before we can measure the aggregate psychology of millions of investors, we have to understand how their individual decisions are recorded in real time.
Right, the building blocks.
Exactly. And in the trading ecosystem, that recording happens via the candlestick chart. But what's interesting is Bensby doesn't view a candlestick as just a summary of a day's trading range. He views it as an EKG.
The EKG, like an actual medical test.
Yeah, a discrete measurement of the asset's heartbeat over a specific time frame, whether that's an hour or a day or a week.
Now, most of you listening are probably intimately familiar with standard candlestick anatomy, the open, close, high, and low.
The basic 4 pillars.
Right. The body is the space between the open and the close. If it closes higher, it's green, which means optimism. If it closes lower, it's red, which means pessimism.
Standard stuff.
But Bensby reinterprets how we should look at the relationship between that solid body and the wicks, those little lines sticking out the top and bottom. He argues that way too many traders get hypnotized by the size and color of the body.
Oh, absolutely. They see a massive green candle and assume it's automatically a safe bullish entry.
Yeah, but the text insists the real psychological story is often hidden in those wicks, or the shadows, whatever you want to call them.
Because the body only tells you who won the battle by the time the bell rang. I mean, it just tells you the net result of that time frame.
It doesn't show the struggle.
Exactly. The wicks tell you how intense and chaotic the fighting was to get to that result.
Okay, so give us an example. How do we read that balance of power?
So let's say you are looking at a daily chart and you see a candle with a really small body but an incredibly long lower wick. Traditional technical analysis just logs that as a support level and moves on.
Right.
But from a sentiment perspective, that long lower wick is a visual record of immense temporary panic followed by aggressive conviction.
Okay, wait, let me translate that. So it means the sellers initiated a massive rout, like they just dumped the asset, driving the price deep into the ground, triggering panic across the board.
Total freefall.
But before that time frame closed, buyers stepped in with so much capital and so much confidence that they absorbed all of that selling pressure and pushed the price all the way back up to near where it opened.
Yes, exactly. It's a visual representation of a violent shift in crowd psychology playing out over just a few hours.
Wow.
And conversely, a long upper wick reveals a failure of conviction. The buyers tried to push the asset to new highs, euphoria started to kick in, but then it hit a wall of sellers who viewed that high price as totally irrational.
So the market effectively rejected the optimism.
Right. Bensby argues that by analyzing the proportion of the wicks to the body, you weren't just reading price levels, you were actually reading the market's internal conflict and measuring the exhaustion points of fear and greed.
Okay, but this brings up a concept from the text that I actually want to push back on a bit.
Yeah.
Because it feels super counterintuitive to how humans naturally process information.
Oh, you mean candlestick independence?
Yes, candlestick independence. Bensby heavily emphasizes that each candle represents a completely discrete time period. Like when the 4-hour candle closes its sealed, the next candle is an entirely separate event.
Correct. No seamless transition.
But if every candle is an isolated island, isn't looking at a chart like looking at a flip book with missing pages? I mean, how do you see the whole story if the data explicitly forces a discontinuity? We naturally want to draw a smooth narrative line connecting Monday's close to Tuesday's open.
Well, you've highlighted the exact vulnerability that the author warns novice traders about, because humans are basically pattern-seeking machines.
Right. We want it all to connect.
Yeah, apophenia, the tendency to perceive meaningful connections between completely unrelated things, is our default state. We want the transition from one candle to the next to be a perfect, seamless story.
But it's not.
No, the reality of candlestick independence means you cannot look at a single candlestick or even two in isolation and deduce the true market sentiment. The gap between Friday's close and Monday's open contains an entire weekend's worth of unrecorded geopolitical news, social media chatter, and shifting anxiety.
Okay, so how does Bensby suggest we bridge that missing data? If the discrete nature of the chart hides the underlying flow of emotion, how do we use it without getting trapped by a false narrative?
By analyzing multi-candle sequences to locate points of absolute exhaustion. The text specifically highlights patterns like the doji, the engulfing pattern, or the hammer.
But not as magic formulas, right?
Exactly, not as magic formulas, but as psychological signposts. So take a doji where the open and close are virtually identical after a long run-up. It isn't just a geometric cross on the screen. It represents a moment of absolute equilibrium between buyers and sellers.
Like a stalemate.
Right. The momentum has flatlined, the conviction is gone, but, and this is key, a doji in isolation means absolutely nothing.
Because of the independence rule.
Yes. It's the context of the preceding independent candles that matters. If a doji appears after a massive sequence of bullish momentum, it signals that the greed is finally exhausted. The crowd is hesitating.
And this forces the trader to utilize multiple time frames, I assume. Like, you might use a 15-minute chart to execute a trade, but Bensby insists you have to zoom out to the daily or weekly charts to capture the broader current.
Always zoom out. The short-term chart is just full of intraday noise, temporary emotional spikes. The longer time frames filter out that noise and reveal the true underlying sentiment trend.
Okay, so I've got the visual footprint down, but this perfectly sets up the text's major pivot. Because even if you master multi-time frame analysis, and even if you can perfectly read the psychological warfare in the wicks of a candlestick,
it is still not enough.
Not nearly enough. Bensby draws a really hard line here. He says technical analysis, no matter how advanced, is completely disconnected from the underlying economic reality of the asset.
Which is fundamental analysis. You are moving from the visual representation to the reality check.
Right. Because you can have a stock chart displaying a beautiful textbook bullish engulfing pattern. The wicks are perfect, the momentum looks unstoppable. But if you are only looking at the chart, you are completely blind to the fact that the company might be like hemorrhaging cash and is 2 weeks away from defaulting on its loans.
Bensby essentially argues that trading on technicals without fundamental analysis is just trading an illusion. You are trading the shadow instead of the object.
A shadow instead of the object. I like that.
The author actually experienced this firsthand. He realized that a chart can show you the historical patterns, but it fundamentally fails to explain why those patterns emerge or if they are structurally sustainable.
I mean, if the price is skyrocketing purely due to speculative hype, but the company's earnings are actually in free fall, relying solely on the chart leaves you totally vulnerable.
Exactly. Gravity will eventually take hold, and the technical chart will not warn you until the collapse is already underway.
Okay, let's unpack this. So if the candlestick is the market's current mood, the fundamental analysis is the company's actual medical chart. We have to dig in and determine intrinsic value. Is the company healthy?
Right. And the discussion in the text dives deep into specific financial ratios, not just as static numbers, but as indicators of systemic resilience.
Let's start with profitability, specifically return on equity or ROE. The text doesn't just treat ROE as a measure of profit, it treats it as a measure of management's efficiency, right?
Precisely. It answers a really crucial question. When a company takes in $1 of equity from its investors, how effectively does the leadership team weaponize that dollar to generate growth?
Weaponize that dollar, I like that phrasing.
A consistently high ROE isn't just a nice statistic to look at, it demonstrates structural competence. It means the company operates like a well-oiled machine, capable of compounding wealth.
And when things go bad?
Well, when market sentiment turns negative and panic sets in, companies with high ROE are historically far more resilient because their underlying engine is still functionally sound.
But profitability doesn't really matter if the company can't survive a short-term crisis, which is where Bensvy's take on liquidity is so interesting.
Ah, the current ratio versus the quick ratio.
Yes. He points out the standard metric, the current ratio, which compares current assets to short-term liabilities. But he actively steers the reader toward the more conservative quick ratio, or the acid test ratio. And the reason comes right back to the psychology of the market. The current ratio includes inventory as a liquid asset. But Bensvy argues that inventory is a total trap when sentiment suddenly shifts.
That is such a vital distinction. Let's imagine a massive retail company. Their current ratio looks incredibly healthy on paper because they have billions of dollars tied up in warehouses full of luxury consumer goods.
Which technically are assets.
Technically, yes. But if a macroeconomic shock hits tomorrow, say, inflation spikes and consumer confidence just plummets, that inventory becomes instantly illiquid.
Right, because nobody's buying luxury goods in a panic.
Exactly. If you relied on the current ratio, you thought the company was perfectly safe. But by using the quick ratio, which strictly strips inventory out of the calculation and only looks at cash and highly liquid equivalents, you get a real worst-case scenario stress test.
It answers the question, can this company survive a sudden evaporation of demand?
Yes.
And that leads directly into solvency and the dangers of leverage, like the debt-to-equity ratio. Bensvy looks at debt not just as a financial liability, but as an amplifier of risk when sentiment turns sour. I mean, in the euphoric bull market, taking on massive borrowed funds to fuel expansion looks like absolute genius.
Oh, everyone feels like a genius in a bull market, but when the environment changes, that same debt becomes an anchor, which is why he pairs it with the interest coverage ratio.
Right.
It's not enough to just know how much debt a company has. You need to know if their baseline earnings can comfortably fulfill the interest payments on that debt.
Because if a company is merely scraping by, utilizing all its profits just to service the interest on its loans, it has zero margin for error.
None. The slightest downturn in steady revenue or a slight increase in interest rates will just choke the company out.
And beyond ratios, he also says we need to look at steady revenue and earnings growth, EPS, and competitive positioning. Like, do they have strong market share or a really strong brand? All of these elements combine to reveal the true intrinsic value.
So if we synthesize this, the fundamental analysis provides the deep context that uncovers true strength or potential risks that the technical charts completely ignore.
So, a stock might look emotionally crushed on the candlestick chart, massive red bodies, relentless selling pressure. But if the fundamental analysis shows zero debt, high ROE, and massive cash reserves, that disconnect is huge.
It presents an incredible buying opportunity. The market is pricing the asset based on temporary fear, completely ignoring its intrinsic health.
But the flip side is equally dangerous. A stock might look euphorically bullish on the chart. But if the fundamentals show declining revenue and toxic debt levels, that upward trend is just a house of cards.
It's a disaster waiting to happen.
However, and this is a big however there, Bensvy introduces a third variable here that complicates literally everything. Because you can have a company with a perfect quick ratio, stellar ROE, and a beautiful technical setup, but they do not operate in a vacuum.
No, they exist within an ecosystem susceptible to global winds.
Right. The macro ecosystem can sweep in and incinerate your entire thesis overnight.
The macro triggers. This is where we zoom out further from the internal health and the visual footprint to the global forces that dictate the flow of capital. The text identifies external forces that can override both the balance sheet and the technical chart.
Let's start with industry and sector forces.
Well, specifically technological advancements. Bensby points to AI, blockchain disrupting old models, shifts in energy. If you hold a position in a legacy logistics company, their fundamentals might look bulletproof today.
Sure.
But if an AI-driven competitor suddenly automates half the supply chain, the macro technological wind shifts violently against your asset. The market prices and that future obsolescence long before it actually damages the legacy company's quarterly earnings report.
And consumer behavior shifts act as a similar macro tide, right? Changing spending patterns can instantaneously reallocate massive amounts of capital from one sector to another.
Absolutely.
Then we hit the political and macroeconomic landscape. And I want to explicitly pause here to clarify to you, the listener, that we are looking at political events strictly through the lens of the source material. We're looking at them as market catalysts, not taking any political stance whatsoever.
Right, the market doesn't care about your politics.
Exactly. From a purely analytical standpoint, capital markets absolutely despise regulatory uncertainty. Trade disputes, fiscal policies, infrastructure spending, when a new policy is proposed that could disrupt supply chains, the market doesn't wait to see if the policy is ethically sound. It immediately begins pricing in the risk. Political instability, elections, global conflicts, they simply equal market volatility and uncertainty.
And the data supports this unequivocally. Major events instantly increase the VIX, the volatility index. They breed uncertainty. And when uncertainty rises, institutional capital retreats to safe haven assets, draining liquidity from equities regardless of how strong their fundamentals are.
But the single biggest macro trigger Bensby highlights is central bank action. The text places an enormous emphasis on how monetary policy, interest rates, and quantitative easing sways market sentiment drastically.
Central banks control the cost of money. It is the ultimate lever. When a central bank lowers interest rates, borrowing becomes incredibly cheap. This stimulates corporate expansion, encourages consumer spending, and generally pushes stock prices higher. It creates a baseline of systemic optimism.
But the moment they pivot, when they start raising rates, the exact opposite happens. Borrowing gets expensive, the economy cools down, and the psychological baseline shifts from risk on to risk off.
And this brings us to a really fascinating distinction the text makes about assessing market reaction. It's not just the objective news itself, but how the market digests it.
Yes, this is so important. You can have a fundamentally healthy company, and a central bank can announce a relatively minor interest rate hike. Logically, the company should be fine. But if the market perceives that rate hike as the beginning of a massive economic downturn, the panic will drive the stock price into the ground anyway.
The objective reality is overridden by the subjective reaction. Some events instill confidence and prices rise. Others breed uncertainty and trigger massive fluctuations and losses.
Which is why the text emphasizes diversifying portfolios across sectors and geographic regions.
Yeah.
You have to mitigate those macro political risks.
Exactly.
So if I'm getting this right, even if a company has perfect fundamental health and a beautiful bullish candlestick chart, a sudden regulatory decision or rate hike can flip the script entirely.
It absolutely can. Which perfectly sets up the need to measure the actual human reaction to these events.
Right. We have the company data, we have the global news. How do investors react to them? This brings us to the absolute core thesis of the book, market sentiment.
The hidden force. Bensby defines market sentiment as the collective psychology, the emotions and perceptions of market participants. It encompasses fear, greed, optimism, pessimism, and uncertainty.
And what I find so compelling is how the text highlights sentiment as a leading indicator. It gives early signals of turning points before they ever show up in traditional fundamental metrics. Like a quarterly earnings report tells you what happened 3 months ago. It's stale. Sentiment tells you what's happening right now.
This concept directly attacks the academic foundation of the efficient market theory.
Oh, right, the EMT.
Yeah, which assumes that all available information is rationally and instantly reflected in an asset's price. It assumes we're all perfectly logical, calculating machines.
Which is hilarious when you look at how human beings actually behave.
Totally. The reality is that emotion-driven movements cause temporary massive deviations from true value.
And different investors use this sentiment data in completely opposite ways. The text breaks down momentum investors versus contrarian investors. Momentum investors basically ride the wave of positive sentiment.
Right. They see the optimism and they buy in, expecting the hype to drive the price even higher.
But contrarian investors do the exact opposite. They look for extreme, irrational pessimism to buy or irrational exuberance to sell, expecting a reversion to the mean.
They hunt for the overreaction because of the ripple effect. When positive sentiment increases risk appetite, it drives demand and creates a bull market. But conversely, pessimism makes investors cautious, increasing selling pressure and creating a bear market. This can affect individual stocks, entire sectors, or even broad indices.
Okay, so the theoretical framework is clear. Sentiment is the driving force. But how do you actually track and measure something as abstract as human emotion? We've established the market as a beating heart pumping capital through the global economy. But how do you hook up a machine to measure it?
This is where technology meets emotion. The text describes using natural language processing, or NLP algorithms.
Measuring the unmeasurable.
Exactly. These algorithms sift through unimaginably vast oceans of textual data, news articles, press releases, social media posts, financial forums, and they assign positive, negative, or neutral sentiment scores.
And Bensby divides this into two streams, right? News versus social media.
Yes. Let's look at news sentiment first. You have groundbreaking product announcements or positive earnings, which generate optimism, versus regulatory investigations, which trigger pessimism.
But there's a catch here that the text points out, which blew my mind. The concept of something being priced in.
Oh, this is crucial.
Let's say a company is expected to have a great earnings report. For weeks, the NLP sentiment is glowing green. Because of that optimism, investors buy the stock aggressively before the report even drops. The good news is already expected by the market, so it's baked into the price.
Right. So when the actual positive report comes out, the response might be totally muted or the stock might even drop.
Because the expectations dictate the sentiment. If you trade purely on the objective news after the fact, you get crushed.
Exactly. And then you have social media sentiment.
The rise of platforms like X and Reddit.
Retail investors sharing opinions on these platforms create massive, self-reinforcing feedback loops that amplify price movements.
A single user posts a hype thread. The NLP detects a spike in positive sentiment. Others get FOMO, they buy. The price ticks up, which validates the original post, and it just spirals.
It is the ultimate manifestation of the herd mentality. Investors just follow suit regardless of fundamentals, leading to these massive speculative bubbles.
But the scary part is, it's not just retail traders on their phones. Even massive institutional investors, hedge funds, pension funds, contribute to this emotional pulse.
They have to. They face immense career pressure to not underperform. If the herd is driving a stock up 200%, the institutional manager often feels forced to buy in just to keep up, effectively institutionalizing the herd mentality.
Okay, but here's where it gets really interesting, and I want to push back on this whole system. If everyone, retail, institutions, everyone is using NLP to read the sentiment, aren't the algorithms eventually just reading other algorithms? Like, does the human emotion eventually get lost in an echo chamber of code?
That is a phenomenal question, and the expert addresses this by pointing back to the text's own warning. Sentiment analysis relies heavily on the accuracy of its data sources. It is not a foolproof crystal ball.
So if a bot posts a sarcastic bullish thesis, the algorithm might log it as genuine optimism and trigger a false wave.
Exactly. It's a tool to contextualize market movements and detect early signs of irrational exuberance or fear, but it's not perfect.
Which perfectly transitions us into the final step. The holistic strategy. We have the charts, we have the fundamentals, the macro news, and the NRT sentiment scores. How do you, the listener, synthesize this without making disastrous mistakes?
Well, the author strongly warns against the danger of isolation. Using sentiment analysis or candlestick patterns in isolation is a trap.
Right, you can't disregard fundamentals.
Never. And you also have to combat your own internal psychology.
Confirmation bias. The text brings up this fascinating point. The human brain naturally seeks patterns. So we might perceive a meaningful candlestick pattern where absolutely none exists, resulting in false signals, like seeing faces in the clouds but with our money.
Which is why Bensby outlines concrete steps for protection and risk management.
Hmm.
Step 1, maintain a healthy skepticism. Approach candlestick analysis and sentiment scores with a critical mindset.
Assume you might be wrong.
Always. Step 2, context is king. Look for confirmation from other technical indicators and validate it with fundamental analysis.
If the chart says buy, but the debt is toxic, walk away.
Precisely. Step 3, diversification. Spread your investments across sectors and asset classes so a single macro shock doesn't wipe you out.
And step 4 is the mechanical failsafe, right? Stop loss orders.
Yes. Set clear boundaries to automatically sell if the market behaves contrary to your expectations. It takes the ego out of it and minimizes potential losses.
And finally, step 5, continuous monitoring. You have to adapt to changing market conditions because sentiment shifts incredibly fast.
You can't just set it and forget it.
Right. So to beautifully summarize the author's ultimate framework, true investment strategy requires combining the multidimensional view of fundamentals with the living, breathing emotional currents of market sentiment. It's the ultimate marriage of the machine and the mind.
It really is.
Well, thank you all for joining us on this deep dive. Let's do a quick, energetic recap of the framework we just built. The market is a living ecosystem. Candlesticks show us the discrete footprints of action and the psychological battles. Fundamentals tell us the true worth and structural integrity underneath. Macro events act as the weather, shifting the winds. And sentiment analysis, via tools like NLP and social media monitoring, lets us read the emotional pulse of the crowd.
But above all, these tools must be used together.
Yes, safeguarded by strict risk management to fight our own internal biases.
And, as we wrap up, I want to leave you with one final lingering question to ponder. It connects to what you were asking earlier. If we use sentiment analysis algorithms to measure the emotional fear and greed of human investors, and as humans are increasingly basing their trades on the output of those same algorithms, are we still measuring human psychology? Or are we beginning to measure the psychology of the machine itself?
Wow, that is a wild thought to end on. So tomorrow morning when you pull up a stock chart, I encourage you to look at it differently. Don't just see it as cold math. Look at it as a tapestry of human hopes, human fears, and maybe a little machine psychology too. Thanks for diving deep with us. We'll catch you next time.